Thank you, Mike. So I'm going to talk about the inflation, monetary policy, economic outlook. And I want to remind you, these are my own views, not necessarily those of anybody else at the Fed. Although I will say our president, Jim Bullard, has been, I think, in the forefront of discussing what the Fed really needs to be doing in the context we're talking about today. So I'm going to say, welcome, everyone. Welcome to Stagflation 2.0. So what does that refer to? Well, Stagflation 1.0, some of you remember, it lasted about 15 years. I'll give you a little bit of a trip down memory lane, what that looked like from 1967 to 1982. And the way things are playing out, I believe we're going to look back and say about 2022, this was the first year of Stagflation 2.0. And given the history, not just the stagflation of the 70s, but in other situations, how difficult it is to get inflation down once it's started to entrench itself, which I think it has done, we could easily be in for a decade of difficulty struggling with this. I think that the Fed's policy response to date, although, as Mike said, it's been a lot, it's up almost 400 basis points, but it started at zero. So we were already at an extremely stimulative level. So part of that rate hiking this year was simply to get us back to something more closer to a neutral stance. I would say that we're still behind the curve. We're pretty seriously still behind the curve. So I don't think we're going to get inflation under control anytime soon. But I do think that these rate hikes will trigger a recession. Either it has begun perhaps or will fairly soon. And so stagflation 2.0, I think is likely, both because the Fed policies are inadequate. And I say I'm speaking for myself, but I think you should listen to President Bullard. He's also been saying that even what's priced into markets now is unlikely to be sufficient. And I believe that that's going to be true as we move into next year. But the longer term or the bigger perspective is that to really get the inflation under control, I think would require a much more aggressive Fed policy. And I don't think that we're in a position for that to happen. In particular, if you think about the Paul Volcker episode, and I'll talk about it a bit, that occurred after a decade of stagflation. So people were already pretty miserable, pretty dissatisfied with the situation. And so the very tough medicine that the Volcker high interest rates represented were certainly not anything that anybody liked, but at least they were to some extent acceptable. And I don't think we're in that position yet. I don't think we're the public or the political leaders are ready to accept the kind of tough medicine that would be needed to cure the inflation that we're facing. So stagflation, what does that mean? Well, it's an ugly word, a made-up word, combining stag for stagnant economy and deflation from high inflation. So here's a picture that shows in the red line inflation each year relative to or subtracting off the previous 15 years average. So what this is saying is between 1967 and 82, every single year inflation was higher than the average of the preceding 15 years. The blue line shows you the disappointing economic growth, the stag part of that word. So the blue is the economic growth in that year, real GDP growth, minus the 15-year average up to that point. And although it wasn't negative in every year, you can see that most years it was, and it on average was quite disappointing. So we had this 15-year period of chronically disappointing economic growth and chronically higher inflation. And people just felt defeated, felt like things were out of control. And so I think that was what was necessary for Volcker to be possible, really. So the interest rate in red here is the Fed funds rate, the Fed's policy rate. Even when Volcker came into office in August of 1979, it was already in double digits. We knew we had a problem. The previous chair, Arthur Burns, was aware that the Fed needed to be tough. When he left office, he said, the fact is the public will not accept the kinds of policies that are necessary to tame inflation. He felt it was just impossible for the Fed to do that. Well, Volcker came in August and October, announced a new set of policies, sort of cleverly changed the benchmarks, switched from interest rate targets to monetary aggregates, and said the interest rates can go where they will. And of course, they went up. The immediate increase in 79.80 pushed the funds rate up to 15%. The blue dash line there is the 30-year mortgage. It also was up in that 14% range. And of course, this pushed us into a recession. Rates came back in 1980, but inflation was not extinguished. And so rates went up again, peaking, and these are quarterly averages, almost 18% in early 81. The mortgage rate also went up to about 18%. And then that longer recession from 81 to 82 did allow the Fed to cut interest rates. Let me just 1 second back up and sum up. I've neglected to mention, during this 15-year period, you can see these vertical gray slashes, 4 recessions, average inflation of 6.5% over the whole 15 years. Unemployment averaged 6%. And it was another 5 years before unemployment went down below that 6% level. So this was a miserable, miserable period. Interest rates up close to 20%. The inflation that the Fed was fighting, you can see here, was double digits when he came into office, reached as high as 12.5% in early 1980, was not extinguished after that first attempt. And so the second round of interest rate increases did push inflation down. You can see there by the end of the period shown down around 3%. So a tremendous decrease in inflation. It took a few years. And of course, the human cost was the unemployment, which is shown in the blue bars, reaching almost 11% at the end of 1982. So the Volcker disinflation was effective. Ultimately, it did get inflation down. Of course, we didn't get all the way down to 2%. That took quite a few more years, but certainly broke the back of double-digit inflation. But it came at tremendous human cost. And that's why I think that the circumstances right now are not right to support this sort of policy again. So looking at the current situation, this is CPI inflation, Consumer Price Index. The top red line there, of course, is the headline measure that includes all the items. And then all of the other lines below that are different versions of a CPI, the measures to try to extract, well, what's the core or the underlying sort of the driving force in inflation? Well, they all basically tell the same story, of course. In early 2021, or actually on a monthly basis, you could go back to late 2020, the inflation process changed. It flipped and started to rocket higher. Clearly, in retrospect, and Fed leadership has already acknowledged this, I think history is going to be very unkind to the Fed looking at this period. Clearly, the Fed should have reacted sooner in 2021. We had, of course, the uncertainties surrounding COVID, the supply chain disruptions, but also massive demand support, fiscal stimulus. And a textbook response of monetary policy would have been to respond to that, to try to tap the brakes early as we started to see some inflationary pressures start to emerge. And then as we move into 22, and the Fed still hasn't done anything, inflation is clearly on a much higher track than it was before. And the Fed only started very tentatively, very slowly to raise rates early in 22. So that's why I am so pessimistic that we are still seriously behind the curve. The next picture here is another version of inflation. This is the PCE, Personal Consumption Expenditures measure. This is the one that the Fed watches more closely, believes it's methodologically a little bit better. Those numbers come in a little bit lower, but the pattern, of course, is exactly the same. Inflation starting to spike in early 21, persisting through 2022, and optimistically, you could say maybe the increase in inflation has maybe slowed or will top out, but there's no indication that we're headed back to 2% anytime soon. In my mind, it's just not plausible to say that this is all temporary, transitory factors that are going to drop out and solve this problem all by itself. And one of the reasons I say that is just, of course, the length that this has gone on, the breadth across these different measures. But also, ultimately, the largest input cost to businesses who are price setters is employment. So what's happening with the cost of labor? Well, as we all know, wages are up. Here's a measure that's rising at a 6 to 7% annual rate. The blue line is employment costs. That includes both wages and benefits. That's rising at a 5% level. So these numbers, these levels of wage growth, and these tend to be more persistent, stickier. This is just inconsistent with 2% inflation. These are now costs that are being built in to businesses who are then going to be trying and have been fairly successful so far in passing those prices through. And of course, this is the wage price process from the 1970s that we're all afraid of setting up. To my mind, it's not a risk, it's a fact. It's now already starting to have provide major momentum to inflation. So what does the Fed need to do? This red line is just one of those measures trying to extract what is the underlying sort of persistent driving force of inflation. This is taking off the extreme measures. It's a trimmed version, looking even just over the most recent months. And we're clearly running at a 5% inflation level. The number that came out this morning was also PCE. The core ex-food and energy year over year came in at 5%. So, I mean, it's just crystal clear that we now have inflation running substantially above the 2% target. So what the Fed needs to do is, sort of basic, is it's got to get the interest rate up over that inflation rate. It's got to create real interest rates, that is in excess of inflation, to start to have any restrictive effect. And, this picture makes it very clear that the Fed was very late to start. And even with these large increases, is still way behind the curve. And so this leads me to believe, and I'll end with a few specific predictions, that the Fed still has a long way to go. And the headline PCE number this morning was 6%. So, you're probably looking at short-term rates well in excess of 5%, either next year or 24. So this is captures a model by Ray Fair, an economist at Yale, who's been for many decades running a macro model, and he's had a pretty good track record. And so this is the comparison. The orange line there is if the economy were to grow at 2%, what that would look like. And the blue line is his forecast. So it's not a huge decline, but it's just very sluggish, stagnant growth. And that's, I think that's the most reasonable thing to expect. In terms of inflation, again, the 2% target level represented by the dotted orange line, inflation may slow a bit, but there's no indication that we're back to a 2% track. And of course, as this persists, we have reasons to believe that people's expectations will change, businesses' expectations will change, and they'll build this higher level of inflation into their wages and prices. And as I say, this is exactly what we saw in the 70s, where it took on its own momentum, and it was just extremely difficult to get that process to reverse. So I've highlighted here, and it'll be in the presentation, there's a link there to an article that came out yesterday summarizing a talk I gave a few months ago, kind of laying out why I think this stagflationary scenario is most likely. And it's kind of, I've given you a quick version of it today. So I think that the Fed's rate hikes continue to be insufficient, inadequate for getting the inflation under control. At the same time, these tighter financial conditions likely will trigger a recession this year, but I don't think they're enough to get inflation wrung out of the system. And of course, that's what I'm getting at, that it's going to be very difficult to break out of this cycle of chasing inflation higher, getting a temporary victory, pulling back, and then having to fight the same battle again. The tough medicine that I think would be necessary under our circumstances today to return inflation to 2% probably would be, I'm going to say, a 7%, 8% Fed funds rate, and possibly as high as a 10% 30-year mortgage rate. Well, you can imagine what that's going to do to the housing market. Already we're seeing housing weakening in most of the country. So would Paul Volcker be the right person? Well, yeah, in principle, Volcker ended stagflation 1.0. But I'm not sure we're ready for Volcker. as I said, I don't think that the malaise we suffered in the 1970s is present today to the same extent. I mean, just the fact that you've still got people talking about a soft landing. The optimistic case of the Fed's only going to have to go to 5%, and then we'll be cutting rates next year. I mean, this is not in any way consistent with these policies that I think are necessary to get inflation out of the picture, unless it turns out that all of those inflationary pressures we've been seeing are in fact transitory, and they all sort of magically disappear all on their own. So I don't know if this is good news or bad news, but we're not miserable enough yet for that kind of medicine. So here are a couple of predictions. I think that the Fed will lift short-term rates well above the 5% that's currently priced in the markets. I do think the mortgage rates will likely go up. I said I think it probably would take something like a 10% rate to provide the sort of shock to the economy and people's expectations that would actually get inflation durably down. I don't suspect we'll get that far this time because I don't think we're ready for it. I think there will be a recession this year. Unemployment probably, in the 6% range, maybe more. Inflation probably will come down. We could even touch 2% again, but I'm not sure that we would stay there. So it's these underlying pressures that are going to be there with us for a while. And so I think that the trend would, sort of bounce back up. Certainly stock prices will be under pressure. I mean, I'm mystified why stock prices aren't lower already, given all of these, increasingly evident inflationary pressures that are going to, I think, require some sort of tough medicine. The housing correction has already started. In some places, I think in San Francisco, house prices are already down 10%. In our part of the country, maybe we'll see 10 to 20% declines in some parts like the Mountain West. Denver is likely to go down much more, 30, 40%. It's probably not going to be like the last housing cycle in that the mortgage underwriting is so much better this time. Probably won't have the foreclosure crisis, but in terms of actual price declines, I think it could be quite comparable. The Fed probably, this will be a guess, probably will cut interest rates in 23 or 24, only because the blowback, the political pressure, I think, will be so severe that the Fed will be under pressure to cut. There will be some sort of recovery, but consistent with that forecast that I showed you, probably an unsatisfactory one, and inflation will bounce up again. So that's the stagflation. And so, that's a characteristic of that period, is we just sort of went through this cycle and felt like, and as I say, Arthur Burns at the end of his tenure believed it was just impossible, that there was no way that the Fed could do actually implement those policies that would be necessary because the public wouldn't accept it. And if anything, Paul Volcker showed ultimately under the right circumstances, that sort of policy can work and it can be accepted. And of course, now we celebrate Volcker as the patron saint, the greatest Fed chairman ever. Remember, at the time he was vilified. So whoever is going to be in that position, it's going to be a very tough call on how to tackle this. So as we were talking a little bit beforehand, I think many of us kind of sense that there is this, sort of toxic mix brewing, and yet there's still so much optimistic chatter about how we're going to cruise through this without any real damage. I think that's really kind of holding us back, and I hope it's not causing people to make business decisions that they might later regret. So in particular, I think the interest rates are likely to remain up, and that's a message that Jim Bullard has been saying, that interest rates are very unlikely to go back to those extremely low levels that we saw anytime soon. So let me stop there. Mike, let me pass it back to you.
Okay, thank you, Bill. That was great. So your comment about the optimistic tenor, the article I read this morning covering yesterday's comments by Chairman Powell, pointing to more of a 50 basis point increase. Again, talking about the possibility of getting into a soft landing. So this is
right.
We are getting very different messaging. So if we do get interest rates in the 7 to 8% range, how does that affect utility operations, utility investment incentives? We're in the process where there's billions of dollars in federal funds being pointed at infrastructure development. Obviously, if those funds are upfront available to firms, that changes the calculus a little bit. But if companies still have to borrow to make some of these major infrastructure investments, Talina, I'm going to ask you to kind of wear the business hat in the conversation today in your role as CFO. How do you see this potential interest rate structure impacting utilities like the one you work with?
Well, first I have to give my disclaimer that I speak only for myself and not Big Rivers Electric Corporation. I don't know why that follows me around, but everyone says I have to say that. Remembering that we're a generation and transmission cooperative, 3 member owners, 3 distribution co-ops, about 121,000 end-use customers, owners. So our motivation is to keep costs reasonable, while of course safely and reliably serving our customers. We're already seeing the cost of borrowing for projects that are midstream. We're seeing that go up. How do you address that from a co-op perspective? You push off what you can. You minimize all your costs that you can, but still that overarching, you're already running at a least reasonable cost, and you still have to serve safely and reliably everyone in your footprint. And that includes if a large industrial customer were to come into the footprint, but that becomes less likely when you see the dismal outlook. So I think from our perspective, it is a continued focus on cost and recognition that the cost of borrowing for projects that are that have already in the planning horizon or are to serve reliably and safely, those just, you do everything you can to control the costs that you can. But the problem with that is the cost of steel is more expensive, the cost of fuel is more expensive, the cost of and when I say fuel there, I mean just the fuel for the countless folks who are out and about doing these things. If we talk about the fuel used to generate electricity, those costs have increased extremely because of the inflation and other reasons. We're fortunate that we do have a fuel adjustment clause mechanism here in Kentucky. We're a regulated co-op by the commission, which is a little unusual in the national scheme of things. We do have the FAC. We're allowed to collect those, those costs almost in real time, which is great, except it hits the ratepayers probably more quickly. It does keep pressure off of going in for rate case. Again, the planning horizon is so long. There are things that are in process that maybe have been funded by some utilities with cash, and the borrowing was postponed as long as possible, which is kind of what you do. That's maybe not, that doesn't look hopeful. If I were looking at the regulated IOU world, I would be thinking probably maybe rate cases get more frequent. Maybe the ROEs will have to go up in order to attract the capital to this world. That was at least the argument from all of us who reduced those ROEs because there were low borrowing costs. So that's it. It's dismal, but you have to remember that we only have so much leeway in terms of what we can choose to do, because we have to provide service safely and reliably at least reasonable cost.
Thank you. You mentioned the ROE, and Bill kind of touched on this a little bit, that we, as economists, we use the language of nominal rates of return and real rates of return, right? And this idea that that there are authorized returns on equity as part of rate cases, and those are nominal rates of returns on equity, and as inflation goes up, the actual return is lower after the inflation cost. So just for folks who may not be as familiar with that language. So one of the reasons we invited Ted to be with us is it's hard to, we wouldn't want to put sitting commissioners on the spot of saying, what would you do if rate cases came in asking for these revisions in response to inflation? So we have a recent commissioner to kind of share that perspective of what it might be like. So Ted, if you were wearing your commissioner hat still, what would you be expecting? What would you be fearful of? How do you think this might go through the process? You need to unmute. There you go.
First, thanks for having me. You're on a great program there. It has a national reputation. I've participated in it. Glad to do so today. Second, I don't have to give the disclaimer anymore. I used to have to just give the disclaimer. I can say where that guy won. I kind of did that anyway, according to some. When looking at all of this, and that's a tough report. Of course, don't shoot the messenger. I hope it's not as bad as forecast. The first thing you have to do as a regulator, in my view, you get into public service because you want to try to make a difference to help folks. And when you see something like this, the inflation and energy costs are degrading the standard of living of all Americans. And of course, it hits low and middle income Americans hardest. It's materially degrading their standard of living. You hope for a bounce back so that changes, but I didn't hear a bounce back in Dr. Emmons' forecast. But basically what it is it's deferred maintenance for low-income folks. You have windshields that aren't getting fixed. You have oil changes that are getting skipped. 2 people are living in a place. Now 4 people are living in a place. You're going from hot dogs to, or from hamburger helper to hot dogs. Elective surgery is being delayed. Of course, the worst thing you can do is when it starts to impair, the next generation. When you start stripping down opportunities for your kids, then you're eating your seed corn. But this is what's going on right now as costs in energy in particular go up. Then all the stuff that you're spending money on that isn't energy, well, it goes down. It just has to. But you have to, center of mind, we're materially degrading the standard of living. Of course, on the energy side, the key driver here is natural gas costs. All these costs are going up. But if you did a pie chart, natural gas costs, the commodity cost used for generation and used for home heating, that's what's driving it. As a policy matter, we need to do everything we can to give consumers alternatives to bite down on that really high natural gas price. Earlier in the year, I got just about as wound up as I've ever been as a regulator because we saw these natural gas prices. Then we had a policy that basically impaired the ability to import solar panels. So we're trying to build solar as an alternative to this stuff. And then there's another policy that's stripping that up. And I know there's a lot of other policy imperatives or human rights imperatives. We're trying to onshore. But when gas is $9 a million BTU, I'll buy solar panels from the devil in hell to protect my ratepayers from that. That's just a reality. These other things might need to happen. But when we're degrading the standard of living of folks, we need to be aware of that. We need to look at any alternative, not just solar, any alternative. Of course, I've talked about demand response forever. We need to give consumers tools to deal with this stuff. Then, we need more gas. We need anything that's not gas, and we need more gas. And when you drop that kind of stuff into the current political environment, you really have a problem. If you're saying the same thing that you were saying when gas was $2, and I'm talking about natural gas, when gas is $8, you probably get it wrong. You're probably getting it wrong. Your perspective needs to change when the gas price moves that much because it's the driver. Like even with the ESG folks, And let me say clearly, if people want to do that, that's great. If financial companies want to offer that as a service, that's great. They should be free to do that. But the folks that are defining what ESG is need to rethink. If you're crimping down on a commodity that's driving up the price, that's degrading the standard of living in low middle income, you need to find that, you need to go back to the lab on what the greater good is. And the greater good might be different at $8 gas than $2 gas. Then when you move away from that issue, and when you're looking at the interest rates and the ROEs, it's a really difficult question that the Fed is trying to answer and that regulators are trying to answer, and that is, what is a normal interest rate? When you look at the charts that Dr. Emmons presented, you saw those highs in the 80s. It consistently went down for 20 or 30 years. There's talk of a chase for yield, fundamentally changing the supply-demand balance of what the price of money is. But then we hit the financial crisis. Then we had QE, and for a while it looked like QE might be a free lunch on some of this stuff, but maybe not when you're looking at the more recent charts. So from 2010, you had a financial crisis reaction to interest rates. Then we first start pulling back on QE. Then we get hit with the pandemic. Then we get hit with a ground war in Europe. So we have all of this crazy going on, and we're trying to figure out what is a normal interest rate. And of course, as Talina mentioned, what a normal interest rate is really important on the ROE side, because you measure your ROE, which has some degree of risk, and then your government and debt in theory has no risk, and it's that spread that's really important. And when these interest rates came down, ROEs went down. Well, the interest rates have turned the corner, and ROEs are going to turn the corner with it. And that's just the reality. I mean, we had some cases where the record closed and set an ROE, then as Dr. Emmons mentioned, you get 375 basis points. Well, we can't do the same ROE when you have a 375 basis point interest rate. Of course, that's not necessarily the interest rate that we're comparing with here, but that interest rate influences the other ones. You can do deferrals. Of course, you want financially stable utilities that aren't deferring investment. Deferring investment isn't a free lunch for anybody, but there's a gray area. We're going to slow down on some stuff, but we want well-capitalized utilities, we want financially stable utilities, and we want them maintaining their plant and equipment in a way that's consistent with reliability. Now, there's a gray area there. We're going to move to the gray area where the costs are a little bit lower, or where the component costs are lower, because more is on ROE, more is on everything, more is allocated to the fact that everything is more expensive. This interest, it's a really tough question, but that's why regulators do what they do. They have to answer these tough questions, but ROEs are going up. Rate cases are going to be more frequent, and all of that makes it really, really urgent that we have alternatives for consumers. So that's what I was thinking about as a regulator. That's still what I'm thinking about now, and I look forward to the conversation. Thank you.
So, David, that tees you up pretty well from the consumer's perspective. Given what you're hearing from Talina, given what Ted's comments are about rate cases coming down the line and what that means, from the consumer side, what's your perspective on this?
Well, thank you for having me. I appreciate the opportunity to be a part of this conversation. It's kind of fascinating. I wish I had good answers, and I will give two disclaimers. One, I'm speaking for myself. These are my opinions. These are my observations. Don't accredit these to my NASUCA members. And two, I haven't cracked an econ textbook in like 30 years, but I do have a little bit of econ background. So, some of these are opinions. I'm sure Bill can take them apart pretty quickly, but I'm going to take just a slightly different tack. I'm going to talk sort of at a macro level and then get to sort of utilities. Sort of macro level, I guess I would fall into the slightly more optimistic camp. I don't disagree with Bill that I think there's going to be some really strong inflationary pressures for a good long time. Just around wages, I think alone. If you can talk about whether supply chain issues sort of sort themselves out. You can talk about whether gas prices come down with drilling because of a world market, or whether they go up because we're exporting, LNG to Europe. There's a lot of sort of those intertemporal things, but I look at a macro level, and a couple of things that I see. One is aside from the Fed monetary policy, we have passed billions and trillions actually of dollars of infrastructure investment, manufacturing policy for this country. I think people haven't maybe come to grips yet or an understanding of what was passed in the last 3 years and how it's going to affect our entire manufacturing base and our entire country going forward. I had sort of this analogy in my head is that, you know, when Eisenhower started building the interstate, people probably thought roads, okay, it's a road, not really understanding what having an interconnected network of interstate would mean for the economy in general. I kind of feel like we're there right now in terms of the money that we'll be investing in renewable energy, infrastructure, transit, transportation, EVs, broadband. You know, all of that is still in play, and that really isn't in any of this conversation. I think that really has the potential to remake our manufacturing policy, remake our economy, and create opportunities that I don't think that we understand yet. So that's going to play into this also. So it's not doom and gloom. I also, interestingly, there was an article that I read by Paul Krugman in the New York Times just the other day, and the data that he presented, and this is a asterisk plus asterisk plus asterisk sort of conversation, but the wage growth that we're seeing, and clearly there is wage growth out there, but if you look at the distribution of wage growth, where wages are growing most, it is in the low income, the lower 50 percentile of wage earners out there. Arguably, that's good, right? I mean, you have people that have been at a $7 minimum wage or something that are now getting up to $15 or $20. You have enormous capacity for job growth in terms of manufacturing jobs, technology jobs. There are kids coming out of college now that are going to have amazing opportunities. Huge wage or a huge workforce sort of problem. And I think that's when I look at it, I think, well, that's going to cause wages to go up across the board for a long time, just because I think there's a lot of demand. But again, that low 50% are the people that struggle most with their bills. So maybe there's a little bit, again, asterisk times asterisk, maybe there's a little bit of a silver lining in this, and that some of the people that we worry about most are actually the people that have a lot of opportunity in this economy. And I get worried when I hear someone from the Fed go, well, the way we get this inflation problem underground is we just basically destroy the economy and hurt people, right? Like we haven't done that for 50 years. So I worry about that sort of thinking get involved. But again, I think at sort of a macro level, there's some different stuff going on. Even when you look back to the 15 years of, stagflation one, the thing that we didn't have during that whole period, really, computers, iPhones, broadband, internet. This is different. So I don't know how exactly it plays out. But again, I think with the amount of money that's going into the workforce, the things that we're going to do to our economy, I think there's reason to be optimistic. Now, that optimism is the inflation problem, right? So yes, I think some of our supply chain issues will sort themselves out. I think some of our fuel issues will sort themselves out. Hopefully we don't, get interest rates to 12% and, wipe out half the market. One concern that I do see in the data that I was looking at is that leverage is much higher now than it has been historically. So when the Fed says, well, the way to fix the economy is to make interest rates really high, basically what they're saying is we're going to bankrupt a lot of people. Okay. I'm not sure that's a good idea, but that is sort of the math of the thing, right? I mean, I think Bill, that's kind of what Bill's talking about in the sense you've got to inflict a certain level of pain to get the economy. I'm hoping it's somewhere in the middle. I'm like the soft landing guy. Maybe I'm wrong, but again, I think there are some macro level things that play here that I don't know that really kind of the traditional look at the economic models take into account. That said, the utility sector, I will tell you, I am terrified a little bit. Aside from the asterisk of I'm hoping that some of the low income 50% of the people have a little more income and are a little more able to pay their utility bills, because certainly they need that help. And to the extent that wage growth helped that's great. It's not going to solve the problem. One of the big concerns I have is obviously with the imperatives, the federal policy and the things that we're trying to do, electrify the economy, create EVs, do all those things. That creates a lot of pressure for infrastructure build on utilities. And you can't make that go away. And I mash that up with the level of aside from sort of the financial incentives that the legislation has provided, the state level mandates and imperatives have really, there's not interest rates went up, I can't meet that state statute, right? You have to meet the state statute. So I think there's some real pressure on utilities to continue to build. Now, could be a great profit opportunity for utilities if they want to do it with equity. I'm not sure that's a good thing. But I will say one of my chief concerns, and I've actually seen it, I think, proposed in one case already, is usually history teaches us with utilities as where there's volatility, they try and shift that volatility out of the shareholder side over onto consumers, just like they did with, Talina mentioned their fuel cost adjustment. Well, they didn't like that volatility. We'll just create an adjustment and pass that down to consumers. I've seen that with an inflation type rider, right? How are most utilities, I think, going to look at this? Well, we don't like this inflation thing. We don't like this wage increase. We don't like these underlying cost increases. We're going to try and create more mechanisms to flow those costs directly down to consumers. So I think that's, to me, in my mind, aside from just the overall price increases that I think we're going to see, wages across utilities are going to go up. That's going to show up in utility rates. We know that infrastructure costs are going up, financing costs are going up. All of those things are going to happen. But I worry that we're just going to spend our time shifting more of those towards the consumer side of the bill. And, that's what history says. So I think that's a bad news sort of situation for consumers. I will say this also, we've gone through a period of very low interest rates. And what I've seen in my career is that the average equity ratio in the capital structure on utilities has gone from somewhere in the mid 40s to somewhere in the mid 50s. We did that in a period where we had probably the historically lowest financing costs that we have. It's like crazy that we would be trying to build all this infrastructure, but our equity ratios keep going up. I think going forward, you're still going to have to rely on more debt. You're going to have to bring those down. And I know the utilities aren't going to like that, and the finance sector isn't going to like that a whole lot. But, we're going to share the pain that Bill wants to, incur. Even high interest debt is hundreds of basis points cheaper than equity, right? So we'll see how that goes. I think that you have to lean more on debt to accomplish some of these, even if the interest rates are higher. There's, you still get the tax benefits of the debt that you don't get out of the equity. So I think you're going to have to shift the capital structure back in how we operate and how we accomplish some of the things, just because there's going to be less headroom involved. And the only way you're going to do it, I think politically, commissioners are going to be quite reluctant. I mean, yes, interest rates are going up. I will say that the rate curve is inverted. So like investors, looking out 2 years or 10 years are thinking interest rates are coming down. So I don't know I don't know how that worked out. The near term interest rates are higher than the far term interest rates in the bond market. So who knows who's going to win that. But I think that's going to be your argument, is how do we protect consumers as utilities, try and accomplish all of the things that they're being tasked to accomplish on our behalf, without shifting all of that cost and that risk down to consumers more directly, which, I guess in Bill's world, maybe that's a good thing, right? It slows, take everybody's money away, it slows everything down. But, from a consumer advocate standpoint, I think that's where the argument's going to be.
Okay. So one of the inflation is an increase in the overall price level in the economy. And we've seen some of that segment, and Bill shared charts that show different breakdowns of the different sources of inflation, different parts of the economy. And certainly in the utility sector, as has been pointed out, fuel costs, specifically natural gas, has been a big driver in this. Some of the supply chain issues, costs of the materials that go into transformers is up through the roof if we think about the electric distribution systems. And then we have the Inflation Reduction Act, which is pumping billions of dollars into buying more stuff, which drives up demand in this particular sector in ways it may not in other parts of the economy. So I'm curious, what are the thoughts on how some of the utility-specific policies might be, to what extent might they be exacerbating inflation in this particular sector in a way that makes the problem even more complicated? And I'll leave that open for any of you to respond to.
I'll give it a rip. Part of what globalization was about was buying it from the cheapest source, no matter what. Now, there are problems with that. There are geopolitical problems with that. There are human rights problems with that. There are economic problems with that. But when you try to onshore, when people offshore to get away from a high cost structure, and you try to onshore back into a high cost structure, and you cover it up with government subsidies, I'm not sure how that's going to work out. That's one part of the economy. And of course, the utilities are so dependent on the commodity. So you can hide a lot of bad stuff with a low commodity price. But when you have bad stuff and a high commodity price, to use Jim Cramer's financial term, folks are getting their faces ripped off. And that's what's happening. There's contradictory policy. I know there are reasons we need to onshore, but if onshoring costs a bunch of money and we're already in a circumstance where low and middle class folks are getting their standard of living degraded, maybe we should think about that. Maybe we should talk about it. Maybe we should have an intelligent public conversation about it. Maybe we should have an intelligent public conversation about how a third of the high gas prices is because we're sending our gas to help Europe. Have you heard one politician say that? No. Maybe we should be talking about these things so we have a more informed public and we can get some public input in terms of what the answers are. Thank you.
Talina, your thoughts on kind of the cost of developing? You had talked about deferring some projects. You've talked about there are some things we have to do regardless. How are you seeing this play out?
Well, I probably could have had an easier job if I'd taken this job 10 years ago. Because I think I'm going to be saying a lot of no. I think I'm probably going to say my advice on that is no. But Chair Thomas is 100% correct, and I often agree with him, but I don't always admit it. That the cost of everything, and now you're adding more things, it will be a disproportionate impact on people who are not able to reduce the amount of electricity that they use. Because it's not just natural gas. The coal markets are also expensive. Try to build something in an area with an RTO, you can't get through the queue. We have 260 megawatts of solar that we're supposed to have been going online soon, and neither of the projects have broken ground. And folks are coming back and wanting to renegotiate. It just seems that I agree there's going to have to be a conversation about the disproportionate, the push and pull of this build more things while everything is getting more expensive.
David?
Yeah, no, I think that's what I talked about in my initial comments was, there's sort of a self-inflicted problem, right? We've set really high standards, really high goals. A lot of states have passed laws that the utilities must meet, and a lot of those were sort of thought through and passed pre this more recent high inflationary period. So to the extent that the inflation stays up for a year or two, or we don't see sort of that moderating effect, yeah, I think there's going to have to be some hard conversations across the board about, where I mean, obviously reliability is job one. Resilience, I think, is getting to be job two with the infrastructure that in the storms. Things like transformers, right? I mean, we don't have enough transformers, and there's no quick fix to that. There are things that we have to prioritize. I know that that's probably going to be a hard conversation. I know that you're already starting to see a lot of the offshore wind on the East Coast taking a pause and saying, well, I know we bid this amount of money when we, put this bid in, but we can't do it now because of the changes out there. So those conversations are going to happen, and you're going to have to reprioritize, and perhaps some legislation is going to have to change. I will say that to the extent that fossil fuel type, natural gas, if natural gas stays high, that makes renewable energy more affordable. I mean, certainly, we can have a whole different conversation about, the inputs to renewable energy and supply chain around all of those. But again, I try to think like 10 years out, like, when all of this legislation that we've passed and the things that we've started to do, and yes, Ted, we're going to onshore some things for good reasons, and they may be more expensive. I'm not going to argue that, but that's also jobs, right? That's somebody's job here building that. And I think, you can have a pretty big conversation around the ethics of where we get some of the things that we get for this economy and whether we should or should not do that. But these is going to be, I think, a continuing conversation as we go forward, because there are going to be pressures that are unavoidable, and there are going to be objectives that we have set that we're not going to be able to meet if we intend to keep rates somewhere in a reasonable range. And again, I think time will play out. Again, I think, Ted keeps saying we're wiping out the low income. I'm sure we're not doing the low income customers a lot of favors, but again, I think, the wage paradigm that we're in right now is actually benefiting a lot of low income people a lot. You go to any restaurant in town, they're having a hard time staffing. Okay, well, that's a problem. It's inconvenience. But they're having a hard time staffing because those people have moved on to better paying jobs, right? I don't know that that's necessarily a bad thing in our economy. So how it plays out over time, I don't know. Again, I tend to not be the doom and gloom. I'm a little maybe more optimistic. I think we can work through some of these problems. I think there's some shiny spots in all this, and I really kind of believe that we are on a path that ultimately 10 years from now, when we look back, is going to prove to be really beneficial for our country broadly.
So Bill, I'm going to kick something back over to you. It's we've heard a few different things here, and I know your expertise is monetary policy, but we have had a large amount of stimulus spending on the fiscal policy side. We've had a reduction in the labor force participation rate post-COVID, where things aren't going back up to the same proportion of workers in the United States participating in the labor market. How much are those exacerbating this inflation problem, and how does that interact with or come into play in your prognostications on what the Fed might need to do? Oh, I think we may have lost Bill. That's a good way to dodge a question.
There you go.
I'm sure that was just a technical glitch, and hopefully he can get back on here soon. There's a question that came in from the audience, and I'll see what you three have to say about this. Due to the enormous needs for capital investments, is this a good time to break up vertically integrated electric companies similar to the interstate natural gas pipelines in order to tap into diverse capital sources, owners, and investors? And then I'll come back to Bill with that other question later.
I don't think so. When Superstorm Sandy hit, there was a small muni that said, well, we can't be a small muni. The answer is, let's join an IOU. And then there was another, IOU, city and IOU said, well, we can't be an IOU. We're going to go be a municipality. When you look at, I'm for price competition. The retail access. I mean, when you get markets even a little bit right, like they have in China, you shoot up like this. 25 years into that experiment, we don't see it. I think we need to get the price right before we talk about competition. If you're using an average price as acting as if all the hours cost the same instead of the actual price, how can you have a market that works if your price isn't really right? I don't think that's a silver bullet. I do think we need to look for more places to put for competitive stuff to happen. The other thing I worry about with retail access is you sell all your assets in a fire sale. Is basically depending on what the natural gas price is, and how it works out depends a lot on what happens, the comparison between your projection when you sold all your assets if you required divestment. I'd prefer a gradual approach. Perhaps our next unit is not all the risk on the ratepayers for 40 years, that we phase into more competition on a unit by unit basis. Thank you.
Talina, David, do you have thoughts on that?
Well, I honestly, I don't, there's sort of a, would it be a good idea piece of that question, which I don't really know. My guess is you'll see more consolidation, not breaking apart, as I think companies get bigger to try and sort of get better access to capital and minimize costs. Can argue about whether it's a good idea. I don't know whether it goes the other way, but history would say you'll see consolidation, not the reverse.
Okay. So I'm going to come back to the question that, Bill, we lost you there for a second. I know your expertise is monetary policy, but some of what we've heard in the conversation today is, we've had fiscal policy that's kind of pushed demand up, and especially in this specific sector. We know that the labor force participation rate is lower post-COVID. We don't see as high a percentage of workers going back into the job market. To what extent are those interacting with kind of your prognostications, or how do those come into play? I mean, how much of this is monetary? How much of it's fiscal? How much is whatever's driving this labor force participation decision?
I think you're right, that it's both demand and on the supply side, not only the headline numbers or things like the supply shocks, but yeah, the weak labor force growth. And part of that is, I think the people are now pretty much in consensus that it's early retirements. That's the big thing there, but also lower immigration. We're down something like 75% in the number of documented immigrants, and that historically has been a huge source of our growth. And along with that, I agree with you, Dave, on the Inflation Reduction Act. These infrastructure things, of course, those take time, but maybe something a little bit shorter term to give us some help on the supply side is in labor markets, is in really looking hard at how can we restart some of the immigration flows that we've lost.
Yeah, and the interesting thing about the early retirements and that is that as interest rates are higher, that actually makes fixed income living more difficult for those households as well, which it will be interesting to see how that plays out over the long term. So we're about at our hour. I'll give you each just a few seconds. Bill, I'll start with you to just kind of recap any thoughts you have, and then Talina, Ted, Dave, just kind of for some wrap-up comments that you might have.
I'll just say, I'm not as in favor of hurting people's livelihoods, not by no means, but I think partly because the Fed made a mistake, and I think the Fed has admitted it. We waited too long, and now it's going to be rougher than it maybe had to be if the policy response had come 6-12 months earlier. And that's just the unfortunate reality. And so this is going to be more of a boom bust than we otherwise would have had. As I said, though, I'm also concerned that because of what's causing this cycle, the inflation, historically, it's very difficult to get inflation down. It takes many years to unwind these kinds of pressures that I think are building up in the economy. So in that sense, and we're not there yet, but I think people are going to say at some point, yeah, we got to get rid of this inflation, and we're willing to do what it takes.
Okay. Talina?
It's going to be an interesting ride going forward. I think that costs will rise in electricity to the end use customer probably faster than some of the other inputs. We can talk about the fact that I don't know that the Infrastructure Reduction Act and the Inflation Reduction Act and the Infrastructure and Jobs Act are going to do things quickly enough to lower the costs. And you still will have stranded costs of existing infrastructure, right? At least in regulated environments.
Good.
If this inflation is going to persist, we need alternatives. We need alternatives to natural gas. We need more natural gas. We need any alternative to natural gas to mitigate the cost impact. And that gets worse if it's an extended period of time with this. And that's a serious problem that's going to cause a political reaction. Maybe too late because nobody wants to talk about this stuff. But if you care about the climate, you've got to care about these costs. Because at some point, these costs are going to bubble up to the top of the list. You need a climate policy that can sustain the political reaction on these increased costs. And all that's a tough balance to make, but we'll see what happens.
Dave?
Yeah, well, thank you for having me on. It's been fun. I wish we could kind of keep going on this for a little bit. You know, I probably fall on the slightly more optimistic side. Again, I don't think we're going to get inflation under control in the near term. I think there's just a lot of underlying pressure that's going to keep it there, and that's going to roll its way through a lot of things. I still think that's better than like crashing the economy, just for the benefit of low interest rates. That's, you're going to wipe out a lot of wealth and hurt a lot of people doing that. So I still believe there's sort of like this happy medium somewhere in there where we bring the economy in and hopefully, the world doesn't explode and we get a lot of exogenous sort of, problems. But again, I think from our standpoint as regulators and consumer advocates and utilities, I think we have to have a continuing conversation, giving the new environment and the new financing environment and risk environment. What are our true priorities? What things can we really do? What is sort of an acceptable level of affordability or an acceptable level of cost increase? The thing we never do is say, look, we will, we'll allow rates to increase by only X percentage. We sort of, the way the mechanics work is if it's prudently built, you can put it in rates and those are what the rates are. We're going to have to probably have some more comprehensive conversations around our objectives, our priorities, our strategies, our financing, and those types of things. Those conversations are going to be harder than they probably were, 5 years ago. But I do think we can do them. And again, I tend to be reasonably optimistic about the path that we are on as a country and what the path as part of that the utilities, gas, electric, renewable, all that stuff plays. So again, I tend to be optimistic and I'm hoping we don't crash the bus in the process because, I think we stand to hurt a lot more people than, we should.
Well, I want to thank all of you for your time today. This has been really insightful on all margins, and we greatly appreciate you taking your time to share your expertise and thoughts with us today. For those of you who joined us on the program, we're grateful for you taking your time. We hope you found this conversation worthwhile and helpful. You can learn more about FRI at fri.missouri.edu, as well as on our social media on LinkedIn and Twitter. To see future Hot Topic hotlines and other programs that we'll have throughout the coming year. Thank you again so much for your time, and we'll look forward to having this conversation some more in another setting. Thank you.